Alright, let's talk. So Trump just became the 47th President of the United States, and if you've been following me for a while, you would know that timing couldn't be any more perfect. We're stepping in one of the most bullish phase of the cycle, what's called the winner's curse phase. And this is the big one. It's running strong through 2025 into 2026. So pay attention because this is where fortunes are made. Let me break it down. What we're about to see could be the most dramatic and prosperous final years of the land cycle. Think about the most explosive bull markets that came right before the Great Depression. In the 1930s, the 1920s, same energy, different time. Now, if you don't know your history, let me paint the picture. In the 1920s, right before the Great Depression, we saw one of the most explosive bull markets in history. From 1921 to 1929, the Dow Jones gained over 500%. In 1928 alone, it jumped by nearly 48%. It was a time of massive speculations, booming consumer spending, and wild confidence in the market. However, in 1929, the stock market crashed hard. Jobs evaporated, things disappeared, businesses crashed, banks collapsed, unemployment hit 25%. And the Dow Jones, it tanked by 89%. That was not a correction. That's a total wipeout. And you fast forward to now, Trump isn't even sitting in the Oval Office yet, and we're already seeing the stock market and Bitcoin hitting record high. But this isn't random. It's not luck. It's just plainly the cycle playing out exactly as intended. But the question is, what are you going to do about it? Let's dive in. So in this video, I'm going to break down 3 key things. The property cycle matters, how Trump's administration ties into it, and most importantly, what we can expect to happen next. Let's start with why the property cycle matters. So here's the truth. Most stocks traders don't pay attention to the property market, and they're missing out. If they understood it, they would see the much bigger picture. Stock market crashing at the end of a real estate cycle are the worst ones. Let me hit you with some facts. Since 1836, we've seen 9 real estate depressions. Big ones like the Panic of 1837, the Panic of 1873, the Great Depression in 1929, and the 2008 subprime mortgage crisis. Every single time, the Dow Jones gets hammered. How bad? The average drop is a staggering 51%. In 2008, it fell 54%. And in the Great Depression, the Dow dropped 89%. Now let that sink in for a second. The stock market overall is like a thermometer for the economy. It absorbs information fast and early, and it lets you know of a coming collapse way in advance. It rides the high of a real estate boom, and when the downturn comes, it's already pricing in the pain beforehand. And when you trace it back, you realize everything comes down to one thing: land. Land controls all. Land is the foundation for almost everything in the market. Let me explain. Land is collateral for loans. It's what corporations build their wealth on. It's where money flows during the boom phase. And it's also what triggers chaos when prices collapse. Think about it. Everybody you know who's truly wealthy eventually put their money back into real estate. Why? Because it always comes back to land. When land values go up, credit expands. People borrow more because their properties are now worth more. And banks can give out more loans. Retailers see their mall spaces go up in values. And tech companies, even their data centers, those massive servers we all rely on, they are all built on land. When land price goes up, profits go up, stock prices soar, and the wealth effects kick in. People feel richer, they spend more, they borrow more, and they invest more. It's all just a cycle of growth. But here's the kicker. When land values hit their peak, everything grinds at a halt. Construction stops because developers can't make profit anymore. Borrowing dries up, defaults pile up, and before you know it, the entire financial system starts to crack. And do you remember how I mentioned the stock market precedes the big turns of market momentums? Here's something to watch. Property and building related stocks are some of the first to peak at the end of the cycle. Why? Because large developers stop building when land prices get too high. It's a sign that the party's about to end. Look at what happened in 2007. Australian house prices were peaking, but home building stocks were already collapsing by 30 to 50%. And by the time 2008 and 9 rolled around, the GFC hit and the dominoes started falling. Right now, home builder equity prices are booming, which tells us one thing: we're not there yet. But here's what to watch for: markets exceeding their previous peaks, which we are seeing right now, super tall buildings being completed, which I will mention later on, flashy IPOs making headlines, recessionary indicators just flashing red. We saw all of these right before the mid-cycle COVID panic in the late 2019, and we'll see it again before this cycle ends. Now let's talk about Trump's return. Trump is back in the White House, and history tells us one thing: every time he's in office, we see a very strong bull market, which eventually leads to the recession. Let's rewind back to the 2019 bull run, right before COVID recession, for a taste of what could be ahead. In June of 2019, Trump was on a 72-hour trip to Japan and South Korea, boasting about building the best economy in the world. But guess what? Around that time, the US yield curve inverted, one of the clearest signs of a coming recession. By December 2019, the Dow was trading at over 100% of GDP, and Warren Buffett himself says that this is the single best measure of where market valuations stand. In plain terms, the Dow was wildly overvalued. Everyone believed that the economy and stock market would grow forever. Spoiler, they didn't. That optimism turned out to be one of the most famous examples of misplaced confidence right before the crash. And then reality hits. Let's talk numbers. In the US, the S&P 500 dropped 34% from its peak in February 2020 to the lowest point in March. The Dow Jones, it fell even harder, losing 37% in one of the fastest crashes in market history. And Australia wasn't spared either. The ASX 200, which tracks the Australian market, plunged 38% at the same time. So in total, about $140 billion in market value was wiped off the exchange. Around the same time, we also saw the biggest IPO history hit the market. Remember one of the signs I talked about before of what to watch out? Big IPO is a major red flag to talk about. So Saudi Aramco, the IPO raised $25.6 billion, giving the company a whopping valuation of $1.9 trillion. A portion of these proceeds end up going straight into funding NEOM, so Saudi Arabia's futuristic gigacities with skyscrapers and robots.
Imagine a traditional city and consolidating its footprint, designing to protect and enhance nature. The line will be home to 9 million residents and will be built with a footprint of just 34 square kilometers.
Now here's why this matters. Tall buildings or tallest buildings are always completed near the peak of the cycle. And I'll talk about this later on. NEOM's key developments are targeted for 2026 and 2027, which lines up perfectly with the expected peak of the current land cycle. And that's our market, and that's the point where the land market, at least in the US and Australia, will reach their ultimate peak. Now let's talk about what's happening right currently, and more importantly, what's coming next. Firstly, we need to understand the difference between the mid-cycle and the end-of-cycle downturns, which we expect to see after this next bull run. The mid-cycle downturn, like we saw with 2019, is usually a stock market phenomenon, meaning it doesn't tend to hit the land market hard, which means the broader economy recovers faster. Why? Because in the US, or overall everywhere, 84% of all stocks are owned by the wealthiest 10% of all households. So when the stock market takes a hit, it's mainly the wealthy people feeling the hit, not the average person. So less panic selling and less chaos. But at the end of the cycle, it's a whole different story. It's a land cycle phenomenon. The property industry employs more people than any other sector. So when the land prices collapse, properties collapse, and it affects every single person involved in that industry. So construction workers, real estate agents, home improvement businesses, banks, retail, and people who own properties, which are a lot more than people who own stocks. And the list goes on and on and on and on. And when land prices fall, everything falls hard. People lose their jobs, people lose their homes, old people lose their retirement funds, people die. And the worst part, when land prices fall, it takes time for the market to recover. Why? Foreclosures. When a wave of foreclosures flood the market, it creates an oversupply of properties. And until those properties are actually sold off, prices cannot rise again. And unlike stocks, buying and selling real estate properties takes time, months, or even years. And plus, the monetary value required is much bigger. So it's really a slow grind to clear that backlog. So where are we now? Let's look at the numbers. US home prices are up 3.4% year over year as of September 2024. Australia, up 6%. Modest growth? Sure. But if the cycle plays by the book, the next year could bring a sharp turnaround. Already on the eve of Trump's second presidency, we're seeing markets react. The Dow Jones futures surged 3% post-election, the S&P 500 and Nasdaq by 2% and 1.5% respectively, and Bitcoin, it hit an all-time high, briefly exceeding $90,000. Now let's connect the dots. Trump has already promised tax cuts on tips, overtime pay, pensions, and corporate tax rates from 21% to 15%. This sounds familiar? It should. This is history repeating itself. Back in the 1920s, US Treasury Secretary Andrew Mellon rolled out massive tax cuts. High income tax rates were dropped from 75% to 75%, phased in across the land cycle's final years, being 1924, 1926, and 1928. At that time, these cuts were celebrated as a win for economic growth. But here's the twist. Without additional land taxation, those savings don't just sit idle. They pour into real estate. And when you have more money chasing a finite supply of land, the result is very predictable. Prices skyrocket. From 1920 to 1926, the median land prices doubled. The extra cash in people's pockets created a bidding war for prime real estate, fueling one of the biggest property booms in history. Look at the chart here. It compares the 1920s property boom to those in the 1980s and 2000s. You'll see exactly how dramatic this was, an unprecedented moment in history. And make no mistakes, those tax cuts played a massive role. However, if you don't understand the role that land plays in the economy, you'll miss one of the biggest drivers of financial markets. Real estate wealth doesn't just stay in real estate, it spills over. And when it does, it has the power to feed the stock market bubbles. And the 1920s are a textbook example of this. During that decade, the massive rise in land inflation didn't just make property owners wealthy, it supercharged the banking system. Banks were able to lend more because they actually earned more, and a lot of that money went straight into speculation, both in real estate and on the Wall Street. Take a look at the graph here. It shows the value of new residential construction alongside the value of new stock issues in the 1920s. You'll notice one pattern. Both markets surged together, feeding off each other in a self-reinforcing loop. But here's the kicker. The wealth created by speculation in the land market didn't stay contained. It poured directly into the bubble on Wall Street, creating the perfect storm. And like clockwork, this all aligned with the 18-year land cycle, setting the stage for the collapse in the early 1930s. So, can we expect the same in the 2020s to result from Trump's tax cuts? Yes, all the stars are aligned and the dominoes are lining up. All of our most reliable indicators are showing this. Tallest buildings. I mentioned this before, and I mentioned how important it is and how reliable it is as an end of cycle marker. If you want to know where we are in the cycle, look at the skyline. Tall buildings are one of the most reliable indicators of market peaks. The tallest building tends to always be approved when times are good and easy money is just all around. It's usually at the start of the real estate cycle or following the mid-cycle economic downturn. Because of the extended construction timeline, however, they typically finish at the end of the cycle, giving us the time of the recession, if not the exact peak. And when this happens, a lot of the high rises just being finished at the same time, they will lead to oversupply, driving up the vacancy rates. And we saw this in 2008 and during the COVID panic, where vacancy rates in some areas soared to nearly 18%. Tallest buildings tend to be, therefore, very, very reliable indicators of market crashes. And the graph below, put together by Professor Eric Ross, gives one of the best visual representation of the phenomenon that I've seen. Right now, the Jeddah Tower in Saudi Arabia, set to become the world's tallest skyscraper, is back under construction. And in the US, the Legend Tower in Oklahoma is poised to take the title of America's tallest building. And these aren't coincidences. They are signals. The dominoes are lining up, and the timing is eerily perfect. Australia tends to follow the US in economic and real estate cycles. While the US is often ahead of Australia in this cycle, the general patterns are very similar, with peaks and downturns aligning closely over time. Historical examples of alignment are the Great Depression, 1929 to 1930s, the post-World War II boom, 1950 to 1960s, the dot-com bubble, 2000, the GFC, 2008. So understanding the US trends can provide valuable insights into what might happen in Australia, making it an essential reference point for investors and market analysts. The truth is, if you do understand the mechanics of the land cycle, you'll see what's coming. And everything I've learned about thus far comes from the incredible work of Catherine Cashmore. She's the mastermind behind all of these insights. So if you do want to dive deeper, check out her newsletter, link in bio. So overall, the question isn't if the cycle will peak, it's when. And if you're ready, this is where fortunes are made. So check out this video where I shared more about the timing of each stage of the cycle so you can make the most out of it.